So I'm just going directly into what the IRC did. As we know, we are guided by the Electricity Supply Act, and it provides us with the autonomy to perform our duty independently and to have a due regard for the public interest. We also have other important documents like the license, the transmission and distribution and supply license, the generation license, and the tariff regime document that guide our process. As part of the weighted average cost of capital, we contracted the service of a regulatory consultant, and for PIA, who conducted a comprehensive review of the IRC's work on the WACC. Initially, as was said, we had already done a depreciation study that was a few months ago, and now we are working on the approval of the weighted average cost of capital. In simple terms, the weighted average cost of capital, just to explore, because we have persons who are listening to us via MO News, for instance, it is used to derive the rate of return investors receive from their investment in a financial company. So, for instance, we know that in small communities we may have small shops, and we may fund the shop either by taking a small loan or either by using our personal funds to buy our grocery item to ensure that the shop is run. Annually, we want to ensure that our shop is going on successfully profitable, and therefore we want to get a return. So in a nutshell, that is what the weighted average cost of capital allows for. It allows the investor or the shareholder to receive a return or like a profit based on the investment that have been made. And same applies to DOMLEC. DOMLEC invests heavily in assets like the generation asset, transmission and distribution asset, building, motor vehicle, just to name a few, to supply electricity to the end users. Now shareholders invested in that to ensure that electricity is provided to customers. So part of the capital structure is, as we said, they may take a loan, and persons might put in their own personal funds to buy shares into the company, for instance. Hence, that is the capital structure. If we go further, we have the WACC formula. Of course, Bill presented it, and in the WACC formula, it determines the method at which that rate of return is calculated. Okay, so we are seeing therefore a fraction of the company's cost of the company's debt, a fraction of the company's equity, and all that is multiplied by the cost of debt or by the cost of equity. As the previous Mr. Vinash said, in simple terms, the cost of debt, more or less, is the interest rate on the loan. And in DOMLEC's determination, they provided to us what the capital structure is made up of. The Commission, as part of our comprehensive review, we looked at DOMLEC capital structure of debt of equity as noted on DOMLEC's annual report for December 2022. And this is shown on page 16 of the consultative document which you have in your possession. At the time of doing the WACC study in mid of 2023, the only annual report that was available was that of 2022 and prior years. So, but thereafter, when the 2023 annual report was presented, the Commission further used the information, financial information of debt of equity for 2023, and we compare whether the debt fell within the same range as that of 2021 and 2022. So here we are seeing the gearing ratio of 46% and 46.49% in 2022 and 2021, 47.69%. When we computed those for 2023, we saw that it fell within the value of 46.8%. It should be shown in the slide, as we can see. So we all agree, both IRC and of course DOMLEC, that the debt fell within the same range, both for 2021, 2022, and 2023, based on DOMLEC annual reports. Further, the Commission, as presented in the consultative document and as presented by Bill, we also assess the debt level of that of other utility companies within the region, and we also assess or verify the correctness of the equity component. Remember, we said the capital structure is debt of equity. So within the region, what we found that for some of the utility, the debt averaged 40% and the equity averaged 58%. It's shown on the next slide. Okay, so we saw that DOMLEC falls within the same range of that of comparable companies in the region, and these were Generator Public Service, that's JPS, GreenLec, the Caribbean Utility Company, that's in Grand Cayman, and Bermuda. So we verified based on the most recent information that was available at the time. In case of the debt component now, as we said, it's straightforward, it's interest on their loans. So Mr. Vinaj and I also presented the slides showing DOMLEC's debt. They have debt, which is their loan that they took from National Bank of Dominica, and also the loan taken from the Caribbean Development Bank. And on average, we have an effective interest rate of 5%, and Mr. Vinaj already expounded about it. So that cost of debt, which is 5%, would be multiplied by the fraction of the cost of debt for DOMLEC, which range about 46%. Therefore, we move on to the cost of equity. And now the cost of equity is more comprehensive. It's a lot of financial and accounting terminology that some of us may not be familiar with. Some of us who are involved in the financing or economic background would have a clearer understanding, but ordinary folks, it might be rather challenging. So some of these terms might be challenging for the ordinary folks. But anyhow, this is something that we must go through because the process allows us. Now, general or worldwide standard accept two methodologies for calculating the cost of equity. And Mr. Vinaj spoke about it. I also presented slides about it, but I will just go directly into what the IRC did. So we, of course, the approach to calculate the cost of equity is, we heard about the risk-free rate, which capture an investment with zero risk. We heard about beta, which look at the systematic risk relative to the market. We look at the market risk premium, which is additional risk paid to the investor for investing in risky assets. So all that is used in determining the cost of equity. There's another methodology that was also spoken about, which is the discounted cash flow. So I'm just going straight into what the IRC did. So DOMLEC submitted their proposal to the IRC. And then the IRC, so for example, they proposed a risk-free rate of 3.74%. The Commission reviewed DOMLEC proposed risk-free rate, and as we said that it was based on the 30-year U.S. Treasury bond from December 2022 to May 2023, and it is shown on page 19 of the consultative document, that is DOMLEC's consultant proposal. Then, based on IRC review, IRC provide a risk-free rate slightly different from that of DOMLEC, 3.75%. And why we chose that? We found that based on the data set used published as at July 19, 2023, we use the 6-month average of US 10-year Treasury bill, and we felt that it was more recent information. So those of DOMLEC were shown over a 30-year Treasury bill and captured the period December 2022 to May 2023. Ours, we use published data, which is also available. We use US Treasury bond based on July 19, 2023. And it's based on, as I said, on the 10-year Treasury bond. DOMLEC was of the view that they choose the 30-year because some of the assets has a useful life of 30 years. But we felt that some of the assets that are in, that DOMLEC also uses, have an average life of 10 years as well. And what we found within the region is that some of them use 10 years, some use 20 years, but what we found that one showing 3.75%, one showing 2.74%, it's not that skewed. So that is why the IRC proposed the 3.75%. Now we spoke about beta and the level, and beta is simply we look at the level of risk and to the company versus the risk to the market. So DOMLEC proposed a level beta. So as the level beta uses risk associated with both debt and equity in the firm's capital structure. DOMLEC proposed a beta using 10-year of daily stock price and the return from S&P 500. I'm using 13 comparable US companies, and this company is used as a proxy for DOMLEC, and it is shown on page 26 of the consultative document. The Commission reviewed and analyzed DOMLEC's data, and the Commission, based on its first discussion, we also had collaborative discussion to settle different tranches as part of the tariff of the WACC process. So we had an adjusted unlevered beta. So the unlevered beta more or less takes off the debt component and more or less look at the equity. It's like how much equity financing contributes to the company's risk. And through much discussion, we arrived at the Commission proposed an unlevered beta of 0.44% using 5-year average of all US electric companies published by one of the financial professor. I think he's a professor. He's Ashwood Damodaran. I do not know if you all heard about him, but he published financial data. So we use the data published by him as of January 2023. And of course, his work is also used by other regulators, such as in our research we saw that JPS used it, that's Jamaica Public Electricity Company, JPS. We saw that Fair Trade Commission also used their data. So these are published financial data sets that can be used for comparability or from benchmarking purposes. the Commission felt that the unlevered beta is more accurate measure to look at the volatility and performance of investment companies relative to the overall market. So the Commission considered that all U.S. electric company is best used for benchmarking as for DOMLEC, as a proxy company to DOMLEC. And we note that there is no exact U.S. company that is comparable to DOMLEC in terms of size and valuation. So hence the reason we use the all U.S. company beta of 0.44. And also what we found when Mr. Bill spoke about if you have a beta of 1 and if you have a beta of less than 1, we saw that DOMLEC beta is more or less than 1 because it's a monopoly, it's the only utility company, there's no level of competition. So the level of risk is not as high as compared to other companies where there's competition in the sector. In terms of, we heard of the word market risk premium, and that is also found as part of using the CAPM model or CAPM methodology. And DOMLEC proposed a market risk premium of 8.27%. The market risk premium, one method, is when you use the expected market return and you subtract the risk-free rate. However, the Commission also reviewed the data set provided by DOMLEC, and the Commission, after reviewing the data published by DOMLEC, which they used S&P 500 index from 1920, which published data from 1926 through 2022, the Commission proposed a market risk premium relative to bonds of 5.06% based on the financial data published by Professor Damodaran, which provides data from 1928 to 2022. So that information was published as of August 1st, 2023, and it is shown on page 24 of your consultative document. So the market risk premium used was 5.06%. Now, the Commission note, and I spoke about it, that part of the research, we more or less kind of liaise and do research in terms of what similar type company use. And we, of course, we are in the region, we have other players in the region. When I talk about players, we look at other work performed by other regulators, that's the Office of Utility Regulation in Jamaica, and also Fair Trading Commission in Grenada, and they use the same data set as IRC is recommending. And of course, we went through the number of data sets used by DOMLEC, S&P 500, we went through it. We, of course, also use Router in assessing the beta value. We also evaluated the U.S. Stock Exchange in terms of the comparable 13 companies that DOMLEC used, and we felt that our proposal would be equitable in allowing DOMLEC to operate smoothly and also looking at the impact of the rates on the consumers. We also looked at DOMLEC's, the other methodology used by DOMLEC, and of course it's part of the IRC, the regulatory policies guided by the Commission to use the discounted cash flow model. And based on the discounting cash flow model, Mr. Vinat spoke about it. The formula is there as well. They use the dividends, look at the future growth, and with all that is taken into consideration. And what we found that, using the CAPM model, DOMLEC arrived at an average of 9.8% 0.17% using capping methodology. Using the discounted cash flow, they arrive at 9.19%. So there is no significant variance. And using the average as recommended by IRC, as stated in IRC's tariff review, there is a weighted average using the two methodology of 9.11%. Then, thereafter, we had a series of discussion. We concluded on a WACC following discussion between both IRCs and DOMLEC, looking at IRC's adjustment in terms of the beta formula, in terms of the market risk premium. We agreed upon the capital structure. We agreed upon the country risk premium. It is also shown in the slide. So after review, the Commission also agreed on it. And at the end of the exercise, the Commission proposed a pre-tax WACC of 9.82% and a post-tax of 7.90%. DOMLEC proposes a pre-tax of 11.63% and a post-tax of 9.3%. In a nutshell, this concludes my presentation, and the discussion is open in terms of the consultative question, whether based on your view, you accept the IRC's proposed rate of 9.82% pre-tax and post-tax. We accept IRC's post-WACC of 7.90%. However, as part of the stakeholder, we accept DOMLEC proposed pre-WACC of 11.63% and the post-tax WACC of 9.3%. Hence the conclusion of my presentation.